Drop it.
Welcome back, my passive income investors. Are we heading into a second crash? Many of you are aware I will never make an investment decision off things I don't know, but that doesn't mean I can't structure my portfolio in a way that will benefit if we head into a crash or even if we don't head into a crash. And I am posing this question today because of an article that is going insanely viral that I'm going to break down for you, talking about the default rate. But first, I want to read some very interesting facts here, guys. Number one, the biggest car rental company, Hertz, filed for bankruptcy. They also own Thrifty and Dollar. The biggest truck company, Comcor, filed for bankruptcy. They have over 4,000 trucks. The oldest retail company, I'm sure you've heard of, JCPenney, just got acquired by Amazon. The biggest investor in the world, Warren Buffett, he took some pretty big losses selling down some of his airlines, his financials, taking a $50 billion hit over the last 2 months alone. I mean, that's Dr. Evil style loss of money. But the biggest investment company in the world, BlackRock, is signaling a disaster in the world economy. And this is only second to Vanguard, managing $7 trillion. The biggest Mall of America, stopped paying mortgage payments. Pretty expected. Most malls are shut down. Most reputable airline in the world, Emirates, but they're laying off 30% of their employees. I think there's other airlines experiencing worse situations than that. The U.S. Treasury is printing trillions to try and keep the economy on life support. They're doing the same in Canada, and it's another reason that I think we may have a second crash, because that government money is about to run out. And then the estimated number of retail stores closing in 2020 is somewhere between 12,000 and 15,000, which I think might be an underestimate. But nonetheless, ladies and gentlemen, let's get into this article, because it's just crazy. This article has 500,000 views. I have a lot of people sending it to me, so let's kind of review this, shall we? It says 2 weeks ago, when showing the uncanny correlation between defaults and unemployment rates, we predicted that the number of Chapter 11 filings that is about to flood the U.S. will be nothing short of biblical. Very powerful statement, as we can actually see the total Chapter 11s have primarily remained unchanged, but unemployment, I mean, it's making up a huge percentage of the working population, because I think there's something like 30 million people unemployed against 160 million U.S. workers. Pretty crazy stuff. And all that was missing was a catalyst. And according to Bloomberg, that catalyst arrived in the past week or so, as retail landlords have been sending out thousands of default notices to tenants who in turn have experienced a collapse in foot traffic, sales, and cash flow due to COVID and are simply unable to pay their debt obligations. Continuing on, the default letters from the landlords are flying out the door, said Andy Gracer, co-president of commercial real estate company ANG Real Estate Partners. It is creating a real fear in the marketplace. And here we can see this little chart that shows the skipping rents from mall landlords. And I mean, this is really core focused, I think, on malls, because we all know anybody renting in a mall space is completely out of business, probably at least for another 3 to 6 months nonetheless. If landlords don't put a pause on their actions, you're going to see more bankruptcies. The questions that becomes who will bail out the landlords and whether their creditors will be just as generous in accepting forbearance. That said, receipt of default notice don't necessarily mean a retailer will get booted anytime soon, especially since there is nobody waiting in line for the real estate. Some landlords are merely sending letters to preserve their legal rights while discussing the situation with tenants and to assure their spot as a preparedness creditor once the default tsunami begins. One such company, Simon Property Inc., says it is in an active negotiation with merchants at its mall and has been taking their tenants' financial status into account. The bottom line is we don't have a contract and we do not expect to get paid, said CEO David Simon during the company's May 11th earnings call. And obviously, we're going to be showing a lot of charts here, guys, of the U.S. shopping mall vacancy rate, which is through the roof right now. And it's going to be real interesting to see the fallout from this. But nonetheless, an earlier Friday, we reported the U.S. retailers have accounted for the bulk of the defaults over the past 2 months, as they were forced a temporary close in response to the CV. So taking a look at the current default rate, obviously retail's at the top. We've got telecommunications, service, and miscellaneous. We got industrial and manufacturing, energy, Then we got healthcare and pharmaceutical. I mean, this is really starting to touch every part of the economy. And I don't think we're heading into any normality anytime soon here, guys. And what do I think about this in general? Well, it's super hard to gauge out because we're watching the stock market explode, especially tech stocks with companies and ETFs like QQQ, taking a look at like Apple, Microsoft, Tesla, Facebook, Google, Johnson & Johnson. A lot of these top tier companies have been basically holding up the entire market. And what I'm showing you here is my portfolio overview, which many of you are aware, but I want to talk about the at-risk part of my portfolio, how I'm kind of setting myself up in case we do head into another crash, because I don't make bets on what I don't know, and I'm definitely not going to just liquidate my portfolio because I think we're heading into a crash. But my portfolio is set up right now, and what I think is going to be considered safe and survivable through this is my consumer discretionaries, my utilities, my technology and information, and my healthcare. Now, obviously, a lot of people think these tech stocks might run into some further issues, and that may be true, but they're going to survive this no problem. They could take a major dip, but their bank accounts are so loaded, and they're still doing major acquisitions. If anything, this is a better buying opportunity for the money they have capable to them. And obviously, utilities and healthcare going nowhere. People are still smoking, doing their addictions. So I am completely comfortable with that half of the portfolio. But with real estate and financials having the biggest exposure to these default rates, that's the real at-risk half of my portfolio. And many of you know I've been highly focused on REITs this year because they crashed. And I want to kind of, dip my toes in case things come back in a couple years. Because 2 years from now, I'm hoping this is just going to be a glass of wine table conversation over dinner, and REITs are going to come back with somewhat of a vengeance. So I believe I picked my best and my most favorite REIT for hopefully what might be a rebound in the next 2 to 3 years. But that doesn't mean that they're out of the woods yet, and there won't be more trouble coming in the next 6 to 12 months. So I don't want massive exposure to these aspects of the economy, but I still want some exposure. Yeah, I definitely want a decent chunk because if things do turn around, I mean, it's going to be one of the greatest buying opportunities of your lifetime. But I'm almost done buying those kind of companies, guys. I've finalized my REIT position just about at this point, minus a couple thousand I still want to throw at it. But at this point in time, I'm mainly just stacking up cash, which makes up 3% of the portfolio. And I'm only buying online businesses and reinvesting dividends. And literally for the next month or two, I'm probably going to focus on continuing to build the cash position in case we do get a second wind crash. I want some opportunity to keep building the portfolio. But now that I'm pretty much finalized with my REITs, as I mentioned before, guys, I'm really going to start focusing on utilities and probably healthcare moving into the second half of this year because I've got my at-risk plays there and I really just want some more comfort in my portfolio so I can sleep easier at night. And you can't get better comfort right now than in utilities and healthcare. In light of that, guys, I just want to remind you to continue to cost average into the market. Be diligent, be safe, because we just don't know what happens. A lot of us didn't see this pandemic coming. I definitely didn't. But now that I'm looking at my portfolio kicking back into almost all-time highs, keep in mind that does include some, capital contributions. But in that same heartbeat, guys, it seems a little bit confusing here. And I think it has a lot to do with the Band-Aid and the money the government is printing off. But at the end of the day, guys, I'm very happy with my portfolio setup and strategy. I feel like I could comfortably walk away from this portfolio, come back in a few years, and I'm going to presume that I'm going to be a lot richer than I am today, hoping I made the right decisions here. And as always, I want to know what you guys think about this in that comment section below. How is your portfolio set up? How much at risk do you think you have? Because as of right now, my at-risk percentage is only 20% with real estate and financials. Now, you can debate that if you take a look at my sin stocks or anything else I'm holding, because I do hold some volatile companies. But at the end of the day, guys, if I lose those, it's not going to be a detriment to my entire portfolio. So stay diligent, stay diversified, and most of all, stay awesome. And slap that like, by the way. But I'll catch you guys tomorrow.